हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 110, दैट इज कंसोलिडेशन ऑफ अकाउंट्स पार्ट 7। लेट्स स्टार्ट आवर टॉपिक। टुडेज डिस्कशन इज रिलेटेड टू अनरियलाइज्ड प्रॉफिट्स ऑन इंटरकंपनी इन्वेंटरी ट्रांजैक्शन, दैट इज कंसोलिडेशन एडजस्टमेंट। इफ होल्डिंग कंपनी ट्रांस इन्वेंटरी टू इट्स subsidiary, then at that time how closing stock, how unrealized profit is to be adjusted. Today we are going to discuss that. So when one group company sell goods to another group company, profit is recorded in the seller's book. Suppose A Limited sells goods to B Limited. A Limited is a holding company, B Limited is a subsidiary. And if one company sell goods to another company, in that case profit is recorded by A Limited. So profit is recorded in the seller's book. However, if those goods remain unsold within the group at the year end, when consolidation financials is prepared, all the assets liabilities is to be merged. At time, if any unsold goods left in the buyer's books, then what happens? If those goods remain unsold within the group at the year end, the profit is not realized from the group perspective. Individually, the profit is realized. Consolidated financials is prepared, the profit is not yet realized because it's a group's company. The inventory is not sold to the outside party. So profit is not yet realized at that time. Since consolidated financial statement treats the group as a single entity, this unrealized profit must be eliminated. So we have to eliminate the unrealized profit at the time of preparing the consolidated financial statement. So downward transaction when happen when parent sells goods to its subsidiary. When a holding company sell goods to its subsidiary, in that case then unrealized profits exist in the parent's book. Therefore no bifurcation between pre and post acquisition, because if parent sell goods, then profit is recognized by parent company and unrealized profit exists in the parent's book. There is no bifurcation between the pre-acquisition and post-acquisition. In case of downstream transaction, an NCI is not affected. Then adjustment entry, consolidated PL account debit to inventory. In case of downward transaction, it reduces the group's profit, reduce the closing inventory. Upstream transaction, if subsidiary sell goods to parent, in that case what happens? Subsidiary is the seller, parent is the receiver. Profit is booked in the subsidiary's book. Then in that case what happens? Unrealized profit exists in the subsidiary books. Therefore profit must be split. If consolidated financial statement is prepared, then in that time that profit is split between the holding and NCI, because the subsidiary company and subsidiaries companies, all the profits and reserves proportionate between the holding and the NCI. Therefore profit must be split between the pre-acquisition profits and post-acquisition profits. A date of sale is not given. Always assume that post-acquisition. Adjustment entry, PL account debit to inventory, effect reduce subsidiaries profit, affects NCI shares. Why elimination is necessary? Because consolidated financial statement should show profits only when the goods are sold outside the group. When the goods sold outside the group, then only consolidated financial statement should show profits in its book. If elimination is not done, then inventory become overstated and profit become overstated. Inventory भी बड़ा रहेगा और profit भी बड़ा रहेगा. Therefore unrealized profit must be eliminated until the goods are sold to the outsider. जब तक कि goods को external party को नहीं sold कर, group companies में sold करोगे, then आपका inventory भी बड़ा रहेगा, profit भी बड़ा रहेगा, unless and until you will eliminate that entry at the time when you prepare the consolidated financial statement. If you will not eliminate, then it will show an overstated inventory and overstated profit. That's why elimination is necessary in order to eliminate unrealized profit from the inventories and also from the group profit. Therefore parent sell goods to the subsidiaries, downstream transaction, and if subsidiary sell goods to the parent, then upstream transaction. Where profit exists, in case of downward transaction, parent's book, and in case of upward transaction, profit existed in the subsidiary's book. Pre-acquisition, post-acquisition bifurcation, in case of downward transaction not required, but in case of upward transaction it is required, because profit is existed in the subsidiary's book. If any percentage held by the parent, that is 70%, 80%, then it should be bifurcated between the pre-post and between the parent and NCI. Impact on NCI, in case of downward transaction no impact, but in case of upward transaction there is an impact on NCI. Entry becomes, in case of downward transaction, consolidated PL account debit to inventory, and in case of upstream transaction it becomes PL account debit to inventory. Now illustration: following are the balance sheets of A Limited and B Limited as on 31st March 2027. Particulars: land and building, A Limited 17,500, B Limited 12,500. Assets of A Limited, that is plant and machineries of A Limited, is 35,000 and B Limited is 19,500. Furniture of A Limited is 6,000 and B Limited is 2,500. Inventories of A Limited is 20,000 and B Limited is 13,500. Trade receivable of A Limited is 28,500 and B Limited is 13,500. Now investment made by A Limited in B Limited is 3,600 shares at a cost of rupees 39,000. Cash at bank of A Limited is 500 and B Limited is 6,500. So total assets of A Limited is 1,46,500 and B Limited is 68,000. Now liabilities, equities and liabilities of A Limited, that is share capital of A Limited, is at the rate rupees 10 per share, that is 1,10,000 and B Limited is 40,000. Security premium of A Limited is 13,000 and B Limited is nil. General reserve of A Limited is nil and B Limited is 10,000. Profit and loss account of A Limited is 14,000 and B Limited is 3,000. Trade payable of A Limited is 9,500 and B Limited is 15,000. So total liabilities of A Limited is 1,46,500 and B Limited is 68,000. Now you are required to prepare consolidated balance sheet after considering the following facts. On the date when A Limited acquires shares in B Limited, the B Limited has a reserve of 2,500 and a credit balance in profit and loss account of rupees 3,500. In determining the values of shares of B Limited, plant and machinery, which then stood in the book at 22,500, was revalued at rupees 27,000, and furniture standing in the books at rupees 3,000 was revalued at rupees 1,800. These new values were not incorporated in the books of B Limited. B Limited had purchased goods from A Limited for rupees 9,000 in January 2027 on 100 days credit, of which 7,000 are still in stock. A Limited sells to B Limited at a cost plus 25%. Solution: consolidated notes, that is note 1, after the date of acquisition, that is on 31st March 2027. All the assets and liabilities of A Limited and B Limited put together, added together. A Limited reserve except A Limited share capital except B Limited share capital except B Limited reserve except the investment made by A Limited in B Limited. All the assets and liabilities is to be added one by one of A Limited and B Limited in order to make a consolidated note 1. So land and building given in the question, that is of A Limited 17,500, so it becomes 17,500. Of B Limited 12,500, so it becomes 12,500. Plant and machineries of A Limited is 35,000, so it becomes 35,000. Of B Limited it becomes 19,500, so it becomes 19,500. Furniture of A Limited is 6,000, A Limited ka furniture 6,000 and B Limited is 2,500, so it becomes 2,500. Inventories of A Limited is 20,000, that is 20,000. Inventories of B Limited is 13,500, so it becomes 13,500. Trade receivables of A Limited is 28,500, so it becomes 28,500 and B Limited it becomes 13,500, so 13,500. Cash at bank of A Limited is 500, so it becomes 500. B Limited 6,500, so it becomes 6,500. All the assets is taken one by one. Trade payable of A Limited is 9,500, B Limited is 15,000. So all the assets and liabilities taken one by one except the share capital of A Limited or B Limited, except the general reserve, profit and loss, security premium of A Limited and B Limited. Now we will make the adjustments. What adjustments is required in determining the value of shares of B Limited? That is, at the time of acquisition, the plant and machinery in the books of B Limited becomes 22,500, which was revalued at 27,000. So there is a fair valuation increase of plant and machineries by 4,500. And furniture standing in the books of B Limited was revalued at 1,800. So there is a decrease in the fair value of furniture by 1,200. These new values are not incorporated. Right now it is not incorporated in the books. So how we will make an adjustment entry? We will make an adjustment entry in the adjustment. Plant and machinery increased by 4,500. So how we will make the journal entry? Initial adjustment, that is upward transaction. Fair value adjustment. Plant machinery account debit, that is 4,000 4,500 because previously the balance in the book becomes 22,500 at the time of acquisition and fair value becomes 27,000. The effect is not given in this consolidated financial statement. We have to give the effect of that. So plant machinery is account debit because the time of acquisition this fair valuation is done, so it will affect the pre-profits. So plant machinery account debit to pre-profits. Initial adjustment downstream transaction that is related to furniture. Book value of furniture is 3,000. The fair value becomes 1,800. So downstream transaction is there because it's a downstream transaction affects the furniture. Furniture value is reduced. Initial adjustment becomes pre-profit account debit 1,200 to furniture and fixture, that is 1,200. These 4,500 is adjusted with consolidated financial statements. So 4,500 which increase the fair value of plant machineries and reduce the value of furniture by 1,200. This is the initial adjustment that is at the time of acquisition. Now after acquisition, at the time of making the consolidated financials, we have to make a depreciation entry also. So depreciation, the plant machineries B Limited at the time of making the consolidation becomes 19,500, but at the time of acquisition it becomes 22,500, which is revalued to 27,000. So there is a depreciation effect. How much depreciation? That is a value on the date of acquisition becomes 22,500, value on the date of consolidation becomes 19,500 of plant machinery. So there is a difference becomes 3,000. That is post acquisition depreciation becomes 3,000 and fair value 27,000. So proportionately how much depreciation is to be calculated if the value becomes 27,000 instead of 22,500. So 27,000 divided by 3,000 into 22,500, so it becomes 3,600. 3,600 becomes the fair value depreciation and we have already charged the depreciation in the book 3,000. So how much additional depreciation is required to be charged due to fair valuation? These depreciation will affect post PL, not the pre-profit. So post PL account debit to plant machinery, the account 600. So it will reduce the plant machinery by 600 and it will affect the post PL. So after acquisition the profits becomes of B Limited, that is profits of B Limited, that is 3,000. Pre-profits becomes 3,500 and post profits becomes 3,000. So there is a loss of 500. So this depreciation is also reduced from post profits of B Limited, that is additional depreciation becomes less 600. That 600 is also affects the adjustment entry minus 600, that is plant machinery reduced by 600, that is the additional depreciation. Now furniture fixture, value of furniture on the date of acquisition, that is 3,000. At the time of making the consolidation it becomes 2,500. So there is a decrease by 500. 500 is the depreciation after acquisition. The revaluation depreciation becomes because the value of furniture get reduced from 3,000 to 1,800. How it will impact the additional depreciation? So subsequent adjustments of furniture, value on the date of acquisition of furniture, that is book value, becomes 3,000. Value on the date of consolidation, that is the book value, becomes 2,500. Difference, that is post acquisition difference, becomes 500. Fair value on the date of acquisition of furniture becomes 1,800. So how much depreciation is to be calculated for 1,800? 1,800 divided by 3,000 into 500, so it becomes fair value depreciation is 300 and already charged depreciation is 500. So there is a saving in depreciation by 200 or reversal in depreciation you can say by 200. So furniture account debit 200, that is furniture is increased by 200 and it will affect the post PL by 200. Impact is, that is post PL add saving in depreciation or reversal in depreciation of furniture add by adding the 200, that 200 is also added in the furniture account, that is furniture add 200. Now inventories, B Limited purchased goods from A Limited of 9,000 in January 2027. This is an intercompany transaction because B Limited is the subsidiary and A Limited is the holding company. B Limited purchased goods from A Limited of rupees 9,000 on 100 days credit, of which 7,000 are still in stock. Closing inventory. Closing inventory in the books of B Limited. Who will recognize the profit? A Limited will recognize the profit. So if A Limited will recognize the profit, then there is no bifurcation of profits between the holding company and NCI. But the closing inventory left in the books of B Limited, the profit is unrealized because it is not sold to the outside customer. Elimination of unrealized profits from inventory. B Limited has purchased purchased goods from A Limited for rupees 9,000 in January 2027 on 100 days credit, of which 7,000 are still in stock. So A Limited sell goods to B Limited cost plus 25%. So downstream, because parent sell goods to subsidiary, it's a downstream transaction. NCI will not affect in this. Cost of A Limited is 100, markup on that is 25%. So selling price of A Limited is 125. Closing inventory in the books of B Limited left is 7,000. Unrealized profits on it becomes 7,000 equals to 125%. So how much is related to 25%? So 7,000 divided by 125 into 25, so it becomes 1,400 is the unrealized profits on 7,000 के stock per 1,400 the profit. That profit is removed from PL A Limited and also removed from inventory. So profit and loss of A Limited account debit by 1,400 to inventory 1,400. That 1,400 is affected in the consolidated note. Inventory reduced by 1,400 and another effect of 1,400 is given here in the unrealized profits on downstream transaction, that is consolidated other equity reduced by 1,400. So that both effects is given because this profits is unrealized in the books of holding company. This is also adjustment entry because in this question what given, that is B Limited purchase goods from A Limited of 9,000, that is the group entry is there, so it will be eliminated from debtor also because debtor is also increased by 9,000 and debtor is also increased by 9,000, so it will be eliminated. Time of making the consolidation in trade receivable reduced by 9,000 and trade payable also reduced by 9,000. Now note 2, equity share capital of A Limited. How much equity share capital of A Limited is there? 1,10,000 of 10 each. So 11,000 equity shares of 10 each, assuming fully paid, that is 1,10,000. Note 3, consolidated other equities, that is particulars. Security premium of A Limited becomes 13,000. Security premiums in the standalone books of A Limited, that is 13,000. In the general reserves of A Limited, there is no such values are there. So general reserve becomes nil. Capital reserve of A Limited, there is no such capital reserve. Profit and loss account of A Limited is 14,000. So it becomes 14,000 in the standalone books of A Limited. On the date when A Limited acquired shares in B Limited, the B Limited has a reserve of 2,500. It is given in the question that on the date of acquisition, the reserve is given. This balance sheet is related to the date of consolidation and reserve is given on the date of acquisition. So B Limited का reserve दिया गया है on the date of acquisition, that is 2,500, and profit and loss which is credit balance is rupees 3,500. And now in the consolidated financial statement, that is on 31st March 2027, the reserve of B Limited becomes 10,000. At the time of acquisition, the reserve of B Limited is 2,500. At the time of consolidation, that is it becomes 10,000. So there is an increase of 7,500 in reserve. And the credit balance in profit and loss account of B Limited is 3,500 at the time of acquisition, which is a credit balance. Now there is a profit of 3,000. So there is a loss of 500, that is the post acquisition loss. Firstly, we will make a note of the general reserve 10,000 of B Limited on the date of consolidation, 2,500, and post general reserve becomes 7,500. This 2,500 is bifurcated between A Limited and NCI, that is 90%. 2,500 ka 90%, it becomes 2,250 and 10% becomes 250, that goes to NCI. And 7,500 is the post profits, that is post general reserve. 90% goes to A Limited, that is 10,500 into 90%, it becomes 6,750. And 7,500 into 10%, it becomes 750. So that's a post profit. Now profit on the date of consolidation becomes 3,000. Now pre-profits becomes, that is at the time of acquisition the profits becomes 3,500 and at the time of consolidation it becomes 3,000. So there is a loss of 500. These 3,000 is the pre-profits and this 500 is the post loss. Now upward fair value of plant machinery becomes, which is adjusted with pre-profits, that is 4,500. The downward transaction of furniture becomes 1,200. 3,500 plus 4,500 minus 1,200, it becomes 6,800. Now post profit, there is a loss of 500 less additional depreciation as we have calculated 600, and there is a reversal of depreciation on furniture becomes 200. So 500 plus 600 minus 200, it becomes the loss of 900, that is the post profit. Pre profit is distributed between A Limited, that is 90%, and between in the NCI, that is 10%. So 6,800 into 90%, it becomes 6,120. And 6,800 into 10%, it becomes 680. And post PL, that is there is a loss of 900, that 900 of A Limited, that is 90%, it becomes 810, and 900 ka 10%, it becomes negative 90. Now total share of B Limited is, how much share of B Limited hold by A Limited? That is 3,600 shares of B Limited at cost of rupees 39,000. How much shares are there in the book of B Limited? That is 4,000 shares. So how much percentage? So total share of B Limited is 4,000 shares of 10 is, that is 40,000. Investment made by A Limited in B Limited becomes 3,600 shares of rupees at rupees 39,000. So percentage of shares owned by A Limited, 3,600 divided by 4,000, it becomes 90%. So 90% stake is held by A Limited in the books of B Limited. Cost of control working note, that is 90%. Stake is held by A Limited. Investment made by A Limited in B Limited is at a cost of 39,000. That investment is eliminated with the equities of B Limited in general reserve, profit and loss of B Limited. And whatever left out, it becomes the capital reserve or goodwill. In this case, the equities of B Limited is 40,000. So 90% of that is 36,000. And remaining goes to the NCI, that is by equity share capital on the date of acquisition, that is 4,000. That is 40,000 ka 10% becomes 4,000. General reserve of B Limited, by general reserve on the date of acquisition 90%, that pre-profit goes to cost of control account, that is 22,500. Pre-general reserve profits goes to NCI, that is by general reserve 10% 250. Post general reserve profit, that is A Limited ka 6,750, that goes to other consolidated notes, that is share of post acquisition profits of B Limited, that is general reserve, it becomes 6,750. The NCI part will goes to NCI, that is NCI ka by post general reserve 750. In PL case, pre-profit 6,120 goes to cost of control account, that by pre-profit 90% 6,120. By pre-profit 10% NCI becomes 680, and by post-profit NCI becomes negative 90, loss of 90. And this loss of 810 goes to other equities, that is consolidated note. Here the other equities, that is share of profit of B Limited PL account, that is loss of 810. And unrealized profit is also given, that is of 1,400. So security premium becomes 13,000. General reserve becomes 6,750. PL becomes 14,000 minus 810 minus 1,400. It becomes 11,790. And now cost of control. This investment is eliminated with equity, general reserve, and post PL. That investment in B Limited becomes 13,000, and equities of B Limited becomes 36,000. General reserve on the date of acquisition becomes 2,250. Free profits of PL, that is 6,120. So total becomes 44,370. 44,370 is more than the investment, so it becomes a capital reserve. So capital reserve becomes 5,370, which is not a goodwill, it's a capital reserve. So other equities capital reserve, as if there is a capital reserve of 5,370. Now non-controlling interest, that is that proportionate share of net asset, equity becomes 4,000. Pre-general reserve is 250. Post-general reserve is 750. Pre-profits is 680. Post-loss is 90. So total becomes 5,590. That is NCI balance. Now we will prepare a consolidated balance sheet, that is property, plant, equipment, that is 95,900. How it is to be calculated, how it becomes 95,900, that is all the assets, that is 30,000 plus 58,400 plus 7,500, so it becomes 95,900. Now goodwill is not there. Inventories becomes 32,100 as it is given in the note, that is 32,100. Trade receivable becomes 33,000 and cash and bank becomes 7,000. So it will be trade receivable becomes 33,000 and cash 7,000. So total becomes 1,68,000. Now in the liability side, share capital becomes 1,10,000 as it is given in the note. So other equities capital reserve, as if there is a capital reserve of 5,370. 70. So total of other consolidated other equities becomes 13,000 plus 5,370 plus 6,750 plus 11,709. So total becomes 36,910. Non-controlling interest, that is 5,590. So non-controlling interest becomes 5,590. Trade payable becomes 15,500. So trade payables becomes 15,500. Total liability and equity becomes 1,68,000. Thank you for watching my video. If you like, please share, subscribe my channel.